Hey guys, what's up? I'm Erin and welcome back to the channel. The 401k is one of the most popular ways in which Americans save for retirement. In fact, over 87 million workers have a 401k. These plans are currently available to 71% of the public workforce. And being that these plans are so wildly popular and that so many people participate in them, you would think that most people understand their 401k, but it turns out there's a very big education gap for 401ks. Depending on the survey, anywhere from 40 to 70% of plan participants do not understand their 401k. And those are alarming statistics. The biggest misconception about these plans is that there's no fees associated with them. In fact, about 64% of those surveyed either thought they weren't paying any administrative or investment fees in their 401k plans or just didn't know if they were. And this is a very big sticking point because investing isn't free. In one way or another, we're all paying fees. So it's best to understand that yes, there are fees and understand just how much you're paying. Because being unaware of the fees you're paying can have very real consequences, like ending up with far less saved for retirement than you expected. I'm a huge fan of the late, great Mr. Jack Bogle, who was an adamant proponent against very high fee structures, and that was really the basis for him founding a little company known as Vanguard. In fact, another legend, Mr. Warren Buffett, had this to say about his friend. If a statue is ever erected to honor the person who's done the most for American investors, the hands-down choice should be Jack Bogle. And that's because of all the work he did reducing fees and making investing really more accessible to the everyday person. We often take for granted how easily accessible low-cost funds like index funds are these days. Even just 20 or 30 years ago, most investing options were far more expensive, and this is largely thanks to Mr. Bogle. But with that said, it's important to note that when you invest, you're likely still facing fees, even if they're small fees. And when it comes to the 401k, sometimes they're not so small fees. There's really two broad categories of fees that investors are facing in this case, and that would be the fees for the funds you're actually invested in, and then the 401k management fees. According to the American Center for Progress, typically the total fees range anywhere from 0.5% to 2.2%, with the average 401k plan still sitting at a 1% fee. And here's why 1% matters. Let's say you're investing $600 a month into your 401k. You're doing this with the goal of having a $2 million portfolio by the time you retire in 40 years. A cursory check with a compounding interest calculator lets you know that you should hit your goal just fine. But what about those fees? Just because you don't get an invoice in the mail saying, hey, it's time to pay your 401k fund fees, doesn't mean you aren't being charged them. Those managers go right into your account and take their fee out. It's built right in. So that means if you're paying the average 401k management fee of 1%, you can't bank on an 8% return. You're actually going to get 1% less, so 7%. Again, take those same amounts, $600 a month for 40 years, but this time with a 7% rate of return, and all of a sudden, you would have a portfolio that's just 1.5 million. Over the course of an entire working career, you lost a quarter of your portfolio over this 1%. And that's why fees matter. And that's why it's so important to understand the fees you're paying in your 401k. Once you have this knowledge, you can make better investing decisions. You can better chart your course to more accurately hit your goals. Next up, taxes. Many older Americans with 401k plans don't realize those monies are taxed when cashed out. And not knowing that you owe taxes on a withdrawal can at best be a financial headache, or worst case scenario, can cause significant financial hardships. If you have a traditional 401k, the withdrawals are taxed as ordinary income. Let's say that we have a recent retiree whose goal is to live on $80,000 a year. He has alternative income sources, but half of his $80,000 is going to come from his 401k as a $40,000 withdrawal. This puts him in the 22% tax bracket, and thus he would owe $8,800 on his $40,000 401k withdrawal. That's a mighty big tax bill if you thought this money was yours free and clear. When it comes to 401ks, you always owe taxes. The real question comes down to when. When it comes to a traditional 401k, you contribute pre-tax dollars. The money gets to grow in the account completely tax-free. Then once you reach retirement and begin taking your withdrawals are taxed as ordinary income. On the other hand, with a Roth 401k, you contribute post-tax dollars, so money you've already paid taxes on. Then once that money's in the account, it gets to grow completely tax-free. Once you reach retirement and start taking your withdrawals, you get to take those withdrawals completely tax-free. So the real question is, do you want to pay taxes now or do you want to pay taxes later? Do you think you're in a lower tax bracket now, or do you think you'll be in a lower tax bracket in retirement? Both types are wonderful options. I'm certainly not saying that one is better than the other. It depends on your individual circumstances. And I know many people who actually split their contributions 50-50. Say 50% goes to the traditional version and 50% goes to the Roth version. Because the truth of the matter is, we have no idea what taxes are going to look like in 20, 30, 40 years' time. The important thing to remember, no matter which 401k you choose, traditional or Roth, you will owe taxes. The question is, now or later? And factoring in your tax burden is an important part of a comprehensive financial plan. In recent years, the popularity of auto-enrollment for new workers and the use of target date funds has made it so that many people are actually unaware of what they're actually invested in their 401k. Now, these two options have gone a long way to improving 401k participation, but that's not to say that they don't have a downside. First and foremost, according to Vanguard, when a company moves from a voluntary opt-in 401k plan to auto-enrollment, plan participation among new hirees goes from 28% to 91%. And that's a great way to get people started on their investing journey. Also, target date funds have become wildly popular in the past few years. And for many companies, these are the default investment options that employees are put into if they don't select their own investments. And how target date funds work is that they follow a glide path based on your anticipated retirement date. The further off retirement is, the more heavily weighted these funds are towards stocks or equities. And the closer you get towards retirement, the more conservative these funds become. Less of an exposure to stocks and more towards bonds and fixed income securities. Now, target date funds can be a wonderful option. They're a great set it and forget it approach for investors who really aren't all that interested in monitoring their investments closely. But they aren't perfect for all investors. And they can only consider the target date funds themselves. They can't consider any investments that are held outside of the target date fund. So if you do have investments outside of a target date fund, this has the potential to create a portfolio that's not really in balance with what you're truly aiming for. I do have a full video on target date funds if you're interested in checking it out. I do think target date funds are a great way to get started investing. And the fact that this is now the default option for many companies is actually a huge step up in my book. For government workers, the TSP, which is the equivalent of the government's version of a 401k, not long ago would default people into the G fund, which is literally just treasury securities, no stock exposure. And as you can imagine, that's not really a great way for most 18, 19, and 20-year-olds to be investing. So the fact that many companies are now defaulting into a stock-oriented portfolio is a huge step up in my book. But I do think it's important, no matter who you are, no matter what age you are, to know what you're investing in. I just want to add a quick note here. I want to clear up a common thing I see for new investors. It's important to remember that your 401k itself is not an investment. The 401k is just the account that holds investments. So once you put money into your 401k, you still have to choose an investment. Perhaps that's target date funds like we mentioned, or maybe it's index funds, actively managed funds, bonds, things like that. Your 401k is simply the account that holds the investments. This is your money you're setting aside for your future. It only makes sense that you know what's happening with your money. You have to know what you're investing in if you're going to be able to create a successful plan. Are these investments going to get you to your goals? Do you have the right asset allocation? You don't simply want to leave your entire future up to chance or accept some default option if that's not the option that works best for you. 401k plans are wonderful. They're the retirement plan that most Americans are going to rely on to build a successful retirement. But you need to know how they work, because when it comes to your money, what you don't know can absolutely hurt you. What you don't know can end up costing you a lot. When it comes to your money, make sure you know what is happening. And the same goes for really any retirement account or any accounts that you have in general. All accounts are going to have their particular nuances, and you want to make sure you know the details. What accounts are you using to prepare for retirement? Do you feel like you fully understand those accounts? Leave your answer in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.